Hey guys, this is Craig.
And this is Adrian.
And you are listening to Cash Talk.
You can find us on Instagram at @TheAdrianHall, at Financial Fowler, at Cash Talk Podcast, and you can email us at cashtalkpodcast@gmail.com. And now for the stuff that we have to say in every episode so we don't get sued.
Discussions in this show should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions. Registered representative securities offered through Cambridge Investment Research, Inc., a broker-dealer, member FINRA SIPC, investment advisor representative, Cambridge Investment Research Advisors, Inc., a registered investment advisor. Cambridge, Movement Mortgage, and Cash Talk are not affiliated.
Movement Mortgage supports equal housing opportunities. NMLS number 39179. Adrian Hall, NMLS number 1752332. NMLSconsumeraccess.org. All right, thanks. Here's the show.
Okay, so as some of my listeners may know, this year I've been working on opening up a new financial services office in Cookeville, Tennessee, and I've been working with a property and casualty insurance agent out there, and have been learning a lot about the ins and outs of being on the business side of property and casualty insurance. And so been talking to Adrian, and we thought it may be cool to have a local Knoxville property and casualty guy come on and give us, his 2 cents on insurances and kind of educate us a little bit on what we need to be looking for on our personal lines of insurance. And then I also just want to talk about some of the struggles that I've kind of been seeing in the insurance world that come from folks commoditizing insurance and, treating insurance premiums like going to the grocery and buying, a carton of milk or something just based on price. That's something that's been happening over the past few decades, but I really see it a lot this year now that I'm spending more time in a property and casualty office. So we've got Stanton on the call today. We're going to be talking about property and casualty and talk about the pitfalls of commoditizing insurances. So welcome, Stanton. I just want to hear you, say what's been a struggle for you as you've been kind of getting into the property and casualty world as an insurance expert, when you run into folks that have, learned to choose insurances based on the cheapest premium. How do you combat that in your job? And, what are some of the ways that you are able to explain to people, this is why you need to not just focus on premium amounts. You need to focus on, coverages and gaps and coverage, things like that. How do you combat this idea in your industry?
Yeah. Great question, Greg. So first of all, thank you, Craig. Thanks, Adrian, for asking me to come on and do this. Like I told y'all, last week, 2 weeks ago, this may be a great sleep podcast. You got me talking property and casualty insurance. So people want to take a quick nap. This may be my part of the podcast, may be the part to listen to. But no, I think the commodity portion of the insurance world. It's funny you asked that. My presentation that I've given to 2 or 3 different people, different companies, is titled "Insurance is Not a Commodity," and I think I agree with you, Craig. I mean, none of us are that old, but insurance to me is now the commercials of say 15% or more. 15 minutes can save 15% or less, whatever it is. I think everyone, our demographic, probably thinks of, not everybody, most people think of insurance as, I need the cheapest thing. And honestly, if you're never going to have a claim in your life, yeah, get the cheapest thing. I mean, but what you're buying is that claim service. And you guys, if you guys have an idea, tell me, but I'm not sure of another product that you don't know what you have right when you buy it. Meaning you'll buy an insurance policy and you don't know what the claim service, what the coverage is like, unless you, 1, have an agent help you with that, or 2, you have a claim. So since you guys asked me to come on the podcast, I've had 2 stories pop up in the past week and a half. Of one of them is a client's father who had a total barn loss, probably about $150,000 worth of stuff, and his insurance company is going to pay $70,000 to him.
Oh, geez.
So, excuse me. So That's just where he wasn't properly protected. Um, there's different clauses in there he didn't know about. He had a bunch of farm equipment that probably should have been scheduled, which he didn't know about. So he's basically getting half of whatever burnt. And then the second one was a new client, soon to be new client, who was with one of the, we'll call them big box insurance companies, that's had her in a hotel room for 110 days so far. And this is not a house fire. This is a pretty minimal, easy claim.
Wow.
But like you said, when you're buying the cheapest insurance you can find, those companies to stay afloat have to cut how much they pay you. So I think she said 8 adjusters in that house in 110 days, whatever it's been, and they're
Wow.
trying every loophole they can to keep the claim payment down. So
Wow.
yeah,
So in those
it's
situations, I would venture a guess that those folks, before they had the claim, thought they were properly protected and did not have any idea that they were going to be in a position where when they needed the insurance, they were not going to be able to get the benefit that they were expecting. So I'm sure that however they went about purchasing those insurances policies, they were led to believe that they were properly protected, but at the end of the day, they weren't. Do you know anything about those two cases specifically? Were those two folks misled by another agent somewhere that may have not been as educated on the policies that they were selling, or do you think that was more of a online self-insured system that was used to enforce those first policies?
well, great question. The first one, I believe it was due to marketing and commercials.
Yeah.
Um, I think, I mean, insurance. If you watch any TV, especially sports, you're going to see at least one insurance commercial every commercial break. Um, it's it's always on there. So I think the first one was probably they trusted what they saw on TV, and that's also why people have such a sour taste in their mouth for insurance. I think is
Right.
you get burnt by an insurance company one time, and now you think they're all like that, which isn't the case. Now, insurance companies, not to just bash insurance companies, they've written their policies a certain way. It's to minimize their losses too. So, um, one thing I think when you're talking about insurance being not being a commodity, I think you first ask what even is insurance. To me, it's a risk transfer. I mean, purely a risk transfer. Um, so if you take auto insurance, for example, that's probably the most risky thing that each one of us does every day. Um, get in your car, going 70 miles down the highway in a capsule. Um, so that's probably the riskiest thing. So people, in turn, buy an insurance policy to pass that risk off to someone else. Um, so to me, if your risks are not properly looked at, because the three of us right now, Adrian, myself, and Craig, all have different risk portfolios. Either how much risk we want to retain, meaning how risky are we. If I have a car that's worth $8,000 and I think I don't need full coverage on there, full coverage meaning physical damage to my car, that means I'm a riskier person. If Craig had a $2,000 car, but he's not as risky and he wants to pass his risk off to someone else, he may need full coverage. So to me, I think if you're the customer, having a good insurance broker or agent, taking a look and really trying to figure out what is it you want. Are you someone that if Adrian has a home claim of $4,000, is he going to file that claim or is he going to fix it himself? Which one would you do, Adrian?
I personally, with homeowner stuff, unless my house catches on fire or a tree falls on it, I'm never calling anybody ever. So that's me.
Perfect. So if I know that about Adrian, I know he probably could have a $5,000 deductible. He's using insurance kind of as a catastrophic. something crazy. He's not going to be a one that has a water pipe burst, costs $1,500 worth of damage, and then file a claim. So for him, I'm gonna say, all right, Adrian, you should probably do a $5,000 deductible if you have those cash reserves, of course. Whereas if you have a first-time home buyer that is buying their first house, and if they had a $2,500 claim and they can't afford that, then we're going to give them the lowest deductible possible. So I think in both of those cases, Greg, I don't think they had someone that really looked at what they really needed. Does that make sense? I know you mentioned kind of buy it yourself online, which
Yeah.
I don't have a problem against, but much like your guys' field, I don't have to use Craig. I can go and research all this stuff myself, but do I want to take the time to do that? Probably not. Am I going to ever be as smart as Craig when it comes to that stuff? No chance. So to me, I don't want to have to learn everyone else's skill set. I would rather say, hey, you take care of it for me.
I get
Right.
that. Question I have for you. So we know, like, what we just talked about with insurance is like most things in life. I mean, if you want to fill up your car, there's a lot of people that will drive from place to place to place and find the cheapest gas price they can find. And naturally, everyone wants to save as much money as possible. How do you find that line between making sure that you're adequately covered while not paying, 7 times what you could if you went somewhere else? Like, how do you, as a consumer, determine that?
Yeah, great question. So shameless plug. I think having an independent agent is probably number one. Independent. So you have two types. You have an independent agent and you have a captive agent. So a captive agent is the ones that have the hundreds of millions of dollars marketing budget. Those are your, trying not to say any names right now, but your big insurance companies. Those agents can only write with their one insurance company. You're an independent agent like I am, then you have access. We have access to, I think, 13 different companies. So if I go and quote Adrian with all 13 companies, you're going to get a vastly different rate. And then if I go and quote it again next year, I'm going to get totally different rates again. Some insurance companies like older drivers. No, I should take that back. They don't like older drivers. They're less harsh on older drivers. You have some people that if you have a good credit score, their rate's going to be better for you. If you have a teen driver, this company may be a little bit better than the others. So I think having someone check all those for you, making sure your rate's in line, making sure you're getting the proper discounts, but then also on the flip side, making sure you're not sacrificing coverage for cost. That kind of answer.
Yeah, that was like
Adrian.
a perfect answer to that question, I think. What do you think, Adrian?
No, that was exactly it. To equate it to lending, actually, let's not even do lending. Lending's boring. To equate it to like sandwiches, how I kind of hear it is, you want to eat, but maybe if you go to a buffet, for an example, versus going to like just this one fast food place all the time, you might find healthier options at a buffet. That sounded weird. Okay. You might find different options. Like maybe there is, if you go with like you and your spouse, you can both get a salad, but if you bring your kid, they can go play in the chocolate fountain. Like it's just being open to whatever that is, so to speak. That makes sense.
I'm right with you. I make analogies for everything, so I think that was a perfect analogy, Adrian.
Hooray!
So I've run into that as well. In the financial services side of the industry, and I totally believe in the value that an independent service provider brings to the table. And, that's the way I view someone like you, Stanton, is, you're just as much of an advisor as I am. You advise on insurance portfolios and risk. And, that's one way I'm sure you have to position yourself with your client base and with your prospects in general, is that, hey, use me as a consultant. Don't use me as a salesman. Allow me to, get into a really, kind of a deep conversation with you about your values and, what's important to you. Let me learn about who you are as a person. And then let's talk about your insurances then, because now I can actually be a consultant and help you decide what you need and where you should go to get it. Am I understanding that correctly?
That's 100% right. And to me, I'd much rather do that. I like building the relationship on the front end, knowing
Right.
who I'm working with, opposed to. It doesn't mean it has to be done that way. I've had several referrals to me that I've then created the relationship after the fact. And you've got someone that if, and I've only been doing it 3 years, so it's not like I've been doing it forever. But if I have someone I wrote 3 years ago, their risk portfolio is going to be so much different in 3 years. And so, to me, I think from the customer perspective, I would much rather have someone that just handles that for me. I always say with my 401k, I don't want to sit there and have E-Trade up on my computer all day making my trades or watching the tickers. I just pay whoever's taking care of my 401k, let them do that because that's what they're good at. Similar to if I'm working on my car. Now, my wife will say differently because I think I can fix everything. Usually turns into a weekend job. I should probably just pay someone that knows what they're doing instead of paying with my time, aka my backsplash that was I said 4 hour job. I think it turned into 4 days. Probably would have saved me a lot of headache if I would have just paid someone to do my backsplash. So to me, that's kind of how I look at it. Is this no one wants to learn insurance and wants to read through policies and know what different endorsements are, or they shouldn't unless they're crazy. So pass it off and let someone else do it. That's my way of thinking.
Sure. Cool, man. So let me ask you, we'll kind of get into a little bit more of a specific question here. What's a common gap in coverage? Let's just talk about home and I guess home insurance, homeowners insurance.
Mm-hmm.
What's like a common gap or missed feature, or what's just a common problem that you see a lot of people running into? Whether it be definitions in the policy or things that people don't necessarily realize. What's one common issue that you see in those
Yep.
types of situations?
You're leading me right into my outline here. I appreciate it, Craig.
Yeah, that's what I'm here for.
I think there you go. I think the first one Adrian hit on earlier, deductibles. If you've got a $1 million home, you don't need $1,000 deductible. I'm pretty sure if you can afford $1 million home, if Adrian did his job right, you probably have more cash reserves than $1,000 bucks.
Right.
So I think your deductibles, number one, making sure it fits, like I said, either your cash reserves or your risk.
Right.
Because as your deductible goes up, your premium goes down. So if, let's say for 10 years, I never filed a claim, I had $1,000 deductible. But if I went to a $2,500 deductible, I saved $300 a year. But you can just multiply that out. I've quote unquote overpaid for the past 10 years. So to me, I think deductibles is number one. That one's pretty easy. You can just look and say, am I comfortable with this? I think another one you said, I think you mentioned clauses. There's some companies out there that have what I call an overtime clause in the actual contract. So when you're purchasing an insurance policy, you're purchasing a contract. And in one of those 60 pages, it'll say water damage that is caused, quote unquote, over time is excluded, meaning they won't pay any water damage that happened, quote unquote, over time. Now, how do you figure out what overtime is? Is overtime 3 days? Is overtime 3 weeks? Is it 3 years? So that's kind of the gray area. So you'll typically see that. I mean, water damage is probably the most common homeowner's claim. And if you had something behind your wall and you couldn't see it, how are you supposed to file a claim for that? So I think as far as clauses go, that's probably the most important, is the overtime clause. Now, when it comes to coverages, excuse me, you've got a lot of things that you can add. So most people know Flood is not covered. You can add that. Earthquake is not covered. That's something you can add. Sinkhole is not covered. That's something you can add. Those three are all kind of fit into what's your risk retention. A chance
Right.
of an earthquake in East Tennessee is pretty low, but that's why you have insurance. It's for the catastrophic stuff. So if I have a client like Adrian who just wants to insure for the worst case scenario, his worst day, we're going to put earthquake on there. We're going to put sinkhole on there. We're going to have flood, as long as the rates make sense, and then increase that deductible. So those are three kind of additional. And then I think I'm going to say cool. I don't know if any property and casualty is cool, but for an insurance nerd, service line is a new coverage that covers anything from any underground utility line, typically your water lines, your gas lines, your sewer lines. Anything from that main to the entry point of your house is not covered. That's on the homeowner. Now, you can endorse it, meaning you can add the coverage for very inexpensive, $25, $40 a year, and you are covering that portion for anything. So most insurance doesn't cover wear and tear. This does. So I had a client 6 months back who had a 1970s house. Of course, the copper water line burst. $6,500, I think, to dig up, repair the line, put grass down, all the stuff. She paid $500. So I think, and that was something that when it rolled out, I called her, said, hey, this is $40 a year. I think you need it because of the age of your home. She said, okay, cool, do it. A year and a half later, she has a claim. So I think, to me, that is taking care of your clients, knowing what the insurance world is doing, and then being able to communicate to them and why they need it. So
Right.
to me,
You're looking out
homeowners,
for people and making sure that they have the coverage they need, and not only that, you're making sure that they have the best chance possible of getting having a claim honored or covered by their insurance company.
Exactly. And then the last, I guess, couple on the homeowners, and this is something it's always terrible to say, and that's I love doing my job once I start seeing the claim side of things. Once I start seeing that he was going to be out $6,500, but we did it right, she's only out $500. To me, I mean, I can actually quantify my value. I provided $6,000 worth of value to her. She probably thinks it's more because it was taken care of and she didn't have to get into getting different contractors out there. The insurance company took care of that for her. So also personal property replacement costs. So personal property meaning any valuables, not even valuables, any property you have, your furniture, your clothes, your electronics, anything in your house. I won't say most. I'd say 50% of the time when I get someone else's policy, I'll see that it is actual cash value. Meaning, if you have a TV you paid $1,000 for, because TVs are super cheap now, but 5 years ago you paid $1,000. Someone comes in and steals all your stuff, or your house burns down. That $1,000 TV they're going to depreciate. Now they only may pay you $400. Which that may not be a big deal, but that claim I talked about earlier where that barn burnt down, that's when it really starts to add up. So if you're getting everything depreciated, if you had $250,000 worth of stuff, which isn't that hard, when you add furniture, you add everyone's clothes, it can add up pretty quickly. If you add $250,000 worth of belongings, and now you're only getting $150,000, that's going to be tough. Probably on the worst day of your life. Let's say it's a house fire. Now you've got to go replace all that on a budget.
Right.
So I think that's super important. It is a little bit more costly, but a saying I heard 2 years ago was when someone calls and files a claim and it's covered, they never ask, how much did I pay for insurance this year?
Right.
So and I try and say that on the front end, like, that first example I used with the barn, he probably would have much rather spend $300 more a year to do it right and get his
Yep.
full money back than save $300 a year and lose essentially 70 grand.
Right. Right.
Mhm.
Well, I think that was really well put. I think you answered my questions really well. I appreciate that. Another thing I've been wondering about, I'm going to ask Adrian this is, Adrian, from the mortgage world, what do you run into as far as common issues on homeowners insurance? When you're trying to close on a deal when a client's purchasing a home. What are some of the common issues you find? And maybe it's not just front loaded during the actual closing. Maybe there's something else that happens that I'm not aware of. I'm not a mortgage expert, but what do you run into commonly as far as the relation of your industry and Stanton's industry?
The thing I run into the most is that people don't think, and that's the only way I can word it. Like they've decided they want to purchase a house. Exciting, lots of moving parts, lots of emotions, and they get very focused on saying, all right, I'm going to find the house. And where I've been doing this for so many years now, I've learned little tricks to kind of encourage people to keep these things in the forefront. So like when you go under contract on your house 30 days before closing, that's when you should start talking about finding insurance. You don't want to wait until 2 days before closing and then we don't know what's going on. You're calling around trying to find somebody, getting whatever rates you can, being upset with the rates. But secondarily, you go through the process of buying a house. You're not thinking about getting insurance, but that also means you're not thinking about those important questions that we've covered in this podcast, such as if I was to take this house I'm buying and package it with like my auto or my life insurance or whatever else, am I going to get the best deal, best terms? Should I move everything somewhere else? So a lot of times I find that people will end up in a situation where like they're doing exactly what we said you shouldn't, and you're calling around, you're getting the cheapest rate, because like what happens on our side is your insurance is usually escrowed, which means that like when you make your mortgage payment, a portion of that is going towards your monthly payments. Like we're saving up to pay for your insurance in the future. And so you get payment sensitive because you hang on to a certain number, and then you may call around and talk to an agent that has exact coverage you need. They're going to pay out when something happens. If something happens, they're going to guide you through it. But because it influences your monthly payment, you don't go with them. You go with somebody cheaper, and then you forget about it until that tree falls on your house. And then you call them up and you're like, oh no, what do you mean this isn't covered? What's going on? I would think like insurance is one of those things where I feel like if Stanton does his job right, you should never have to call them once a year or call them every few months to see what's going on, but you should know you should count on them when the day comes. But it's one of those things, just like all the other decisions. I think if we as an industry spent more time educating and saying this is just as important as getting the best rate, as finding the best price, as negotiating all the correct repairs, getting your insurance is just as important, because you're not thinking about it today, but you will next year whenever something happens. That would change the game, in my opinion. That's probably the biggest pressure point I feel, but I feel like that's just a lack of education generally, just like with autos, for an example. I mean, you often don't know what type of coverage you really have. And so you get a flat tire or you need to rent a car and you don't understand why they're not just writing checks and you're just unaffected. So I don't know. That's my thoughts.
Yeah, no, cool. I think those are great points, Adrian. And I was a first-time home buyer not too long ago, and I've got lots of friends and clients that are now in that space. There's so many decisions when you're buying your first house, and there's so much money coming out of your pocket, and it's overwhelming. So I get why. I mean, I did it. I went and found the cheapest thing I could because I needed my payment to be this much a month. So therefore, my insurance had to be this much a year. And you want someone that's just going to do it quick, get it over with. So I don't blame first-time homebuyers, especially because, one, the education point. I try and do that with a lot of real estate people, mortgage people. Just they don't need to be insurance agents, but if they can help guide their person, I think that provides value. But I do agree. I think maybe if you were a first-time home buyer a year ago or 2 years ago, and you've got a little bit more time, that may be the time to, if you've got a broker you trust, to say, or an agent you trust, to say, hey, can you look over this? Does this look right? Am I properly covered? Am I overinsured? That rarely happens, but it can happen. Am I underinsured? What do I need here? Am I getting the best rates? I think that would help quite a bit. And typically, you'd be pretty surprised. I'd say, I should have even said this, maybe 65, 70% of the time, I can increase someone's coverage while saving money at the same time. So it's not a either or. I just need someone to take the time to do this for me.
Right. That's cool. So, for the type of person that's, really, really trying to do things by the book and wants to have proper coverage for their first home when they close on that home purchase. Stanton, Adrian, I guess this is a question for both of you. When is it advisable for a person to go ahead and reach out to an independent insurance, advisor? When they've, made an offer on a home and that offer's been accepted or what have you. When does that timing make sense? And, what are some of the things that are involved with getting that quote to begin with? Can you guys walk me through that?
You want to go first or me, Adrian?
You go first.
Okay. As soon as possible, I think. I think once you have an address, either if you know someone, if your realtor or mortgage person knows someone they trust, or if you want to call me, another shameless plug, I think earliest is best, especially for us. Like I talked about earlier, we're not a one company quoter, so it's not a, hey, give me your name, address, date of birth, give me 15 minutes and I'll have a quote back. For us, it's probably 48 to 72 hours. And that's because it is a little bit more of an in-depth process. I mean, we're getting 12 different quotes for you. And then typically what I'll do is I'll put together, if it's not a first-time home buyer, if you already have a current, I'll put together a little side-by-side comparison showing you what we're changing and what the premiums are. So it's a little bit more hands-on for us. Now, if you're using a captive agent, they can usually turn around those quotes probably half a day, depending on how busy they are. So I think earliest is best, of course. And then as far as information goes, it's really not too much. It's names, dates of birth, your new address, your old address. I can pull most of the information from a Zillow ad or a property assessor. So as far as the home, that's pretty simple. Maybe some updates if the roof's been updated, if it's an older home, has the wiring been updated, that kind of stuff. And then the auto stuff. So your VIN numbers, your driver's license. Because like you were saying, you always try and package them. And you've seen it on all the commercials, but you do save usually around 20% if you're combining your home and auto. So like Adrian said, I've had people that bought their first house 6 years ago and still have separate insurance policies. So they've been overpaying probably 20% on both policies for 6 years. And that's probably just because they don't want to deal with insurance. I get it. If I wasn't in this industry and loved it, I wouldn't want to deal with insurance. So I think I'm rambling now, but on your question, as soon as possible, like Adrian said, probably 30 days out, and then very simple information. And then you should have a quote pretty quickly. And if they can work you with your mortgage advisor, I think that makes it a whole lot easier too. Kind of takes you out of being the middleman.
Yeah. I think my answer is very similar. Once you have concrete, that's when you should do it. If you are just, whether it's house buying or car shopping or whatever, if you're just saying, oh, I'm looking, it's going to be very difficult to get specifics because like the agent doesn't know what they're insuring, so to speak. So once you have an address, I personally push like my clients in the first 5 business days. That's when you should be talking to an agent. Like that's when you want to sit down, talk to multiple people. If you want, talk to the person or people I recommend, call around, get a feel for what that particular property is going to cost to insure. And like you mentioned, lay it out side by side by side. So if you do find yourself shopping around, you can make sure that the coverages are the same, because it's kind of like slide of numbers where, the Dollar Tree, for an example, has mouthwash for $1. But if you go to Target, it can be 96 cents. But which bottle is bigger, which bottle is smaller, which one has a higher alcohol content? It's kind of like that, where if you want to make sure you're looking at it, look at it apples to apples across the board. And you can only do that and make an informed decision if you have time. If you're rushing, if it's impulsive, you're going to get a rushed result. If you exercise your right to take your time, then you'll get a higher quality product you feel better about.
Well said. Heck yeah. Well, I've learned a lot today about, insurances, and, I appreciate you, Stanton, for coming on and sharing a little bit of your expertise with us and our listeners. But I just want to, open it up just to you guys to say, is there anything that you guys think that we haven't covered that we should cover? Or do you think we've done a good job of kind of covering all of our bases here?
Well, I think we're missing one thing, and I think that gets missed a lot when we talk insurance, and this is more to Craig's world, liability. Most people, when you talk insurance, they think of protecting their stuff, their house and their cars, or their jewelry, guns, whatever it is. But to me, insurance is really, like we talked about earlier, risk transfer. You're trying to put the risk on someone else. And as everyone knows, we live in a very litigious society now, where if Adrian and I are friends and I go over to his house, we can be the greatest of friends. But as soon as I slip and fall on that stair that's a tad bit crooked, I could sue Adrian. I mean, and now, even if Adrian weren't at fault, Adrian now has to defend himself in court. So to me, liability, especially on the auto side of things, like I said, driving's probably, unless you're a skydiver or some underwater welder, driving's probably the most dangerous thing we do daily. So I think liability, and maybe we should start off with the definition, but your liability coverage is typically $300,000, $500,000 is what we'll do. Now you can get down to state minimum on the auto, where you have $25,000 for bodily injury per person, $50,000 per accident, and $15,000 worth of property damage. So when we were talking about it not being a commodity, if I'm trying to save a buck and I go and get state minimum limit auto insurance, yeah, I'm paying $39 a month. Awesome. Well, if I'm not paying attention, I pull out and I hit Adrian's Lexus. I would say, not to want you to share your finances, Adrian, but I'd say your Lexus is worth more than $15,000. Do you agree?
Oh yeah, especially in this world. Oh yeah, 100%.
Exactly. So cool. I paid $39 a month, but now Adrian's $40,000 Lexus, I'm on the hook for, what is that, $25,000?
Right.
I don't have $25,000 in cash reserves. So what are they going to do? Garnish my wages. Now I'm paying Adrian $25,000 maybe over the next 5 years, 10 years. I don't know. Same thing on the bodily injury side. So if you had that state minimum coverage and I hit Adrian, not only did I total his car, let's say my wife and I were in a bad wreck 7 years ago, right before our wedding, and she tore her ACL and meniscus. Well, you guys know medical costs. There's no way you can fix an ACL and a meniscus and go through rehab for $25,000. It's not possible. So same scenario there. Adrian tears his knee up. His medical bills are $55,000. because his medical insurance isn't going to pay that. Now I'm on the hook for his property damage and his bodily injury. And that's not even that crazy of a scenario. I'm not trying to be like a doomsday guy, but me just pulling out and hitting Adrian isn't the craziest scenario. And now I'm in the hole $60,000.
Right.
So to me, liability is getting very uplifting. But I think liability is probably the most important thing when it comes to insurance, making sure it's proper. If you've got a little bit of either name recognition or you're perceived to have some money, you really need top of the line liability limits, and you need that umbrella. Umbrella meaning it's an additional million, 2 million, 5, 10, whatever you want to make it, of liability coverage to cover your assets. That also pays for your attorney. So like I said in the example where someone slips and falls at your house, they may never win in court, but you're still going to have to pay an attorney unless you want to become an attorney up by Google. And those attorneys aren't cheap. So your insurance is going to pay for your attorney. So to me, I think having your proper liability limits, that's a convo that Craig and I have had when we're talking about his clients, making sure if their net worth is 1.5 million, we need at least $2 million worth of liability coverage. Just for that, like I said, insurance is your worst day. So insuring for that worst day, you make one mistake, you pull out and hit someone, or you rear end someone, or whatever it is. I think liability is super important.
Yeah,
Yeah,
I have. Go ahead.
I was just going to say, when you think about catastrophic events that ruin someone's finances or their plan, if you will, a lot of the times it comes down to a medical event. And Stan, you're perfectly right. I mean, it doesn't have to be your medical event. It could be someone else's, and it could be, due to something that happened on your property. And like you said, that can be a really big catastrophic thing to your household finances. And, you're right. We've had that conversation. That might have been one of the first conversations we ever had when we were having coffee at like K-Brew or wherever we were. And that was, I really, really, really like it when, the insurance, experts that I refer to people make sure that my clients have good liability coverage. And that's exactly right. I'm glad that I asked if we needed to cover anything else, because that's a huge one. Thank you.
Yeah.
I think I don't even go ahead, Adrian.
Oh, no, sorry. I have a double-sided comment to that too, to speak on liability. On one side, in the interest of this being a personal finance podcast, if you are working to get your finances in order and you're finally getting some headway and you end up being the underinsured driver, get into an accident, cause somebody financial peril, that will set you back years or decades easily. And on the other side, something that I've become aware of in the last couple of years is I have spent a considerable amount of time paying off debt, trying to build wealth, and I've been very public about that. Something I've been more private about is the fact that I have increased my insurance accordingly, because people can like joke and say, "Oh, well, you're rich. I know you can afford it." And then when they get hurt at like a barbecue of mine, suddenly it doesn't become a joke anymore and it becomes a lawsuit. So
exactly.
Yeah. Well, yeah, I think this is. Go ahead.
No, finish that. I couldn't hear you there for a second.
Nope, you are totally fine. Floor is yours. Go right for it.
Okay. No, you're 100%. You're 100% right, Adrian. And also, I typically talk about either you have wealth or perceived wealth. But when Craig and I talked, I had a little couple examples for him. If you're someone like myself, 29, young family, I definitely don't have a great amount of wealth right now. But let's say my daughter's only 2, but let's say in 2 years she has a friend over, and that kid gets hurt at my house. Now you're really talking lawsuits. Either if dog gets them, or if they're on the trampoline, or if something happens in the pool. Like, that to me is worst case, especially when you have kids. So if you've got people that don't think I don't have wealth. I don't need the insurance. Well, if you have a kid, I think you do. Because once you have kids, I think you kind of you change everything. I would do anything for my daughter. Now, if she got hurt, would I sue her friend? Probably not. But I think a lot of people would. Or in Adrian's scenario, his maybe not best friend, but his very good friends who get hurt at a barbecue now look at Adrian like a paycheck. If if they got hurt and they leave the scene and they're like, I'm fine, but a couple days later they have a personal injury friend that says, hey, that could be worth $100,000. They're really going to start thinking, how much is Adrian's friendship worth to me? And not saying all people are like that. Again, I sound like a doomsday guy talking insurance, but I think that's what my job is to make sure that you're covered for the worst case scenario. So then when Adrian has that barbecue, he doesn't have to sit there and think, is this done properly? Is this done properly? Just making your life a little bit easier. I'm trying to find a way to end on a high note, guys.
I've got
just
it
been
for
talking
you.
Worst case all day.
So I can
What do
make
you
it
got?
less scary. I don't know if you end up in that situation where, like, you're having barbecue, somebody trips over a lawn chair, breaks their leg or something on the cement. I don't think they'll be so sinister and look at you and say, oh, time to pay up. I think our friendship is worth, this dollar and this cents. I frame it more of like, accidents happen. It's like we judge people based off of their actions. We judge ourselves based off our intent. So if you're driving down the street and somebody cuts you off, they intentionally did it. But if you cut somebody off, it was, oh crap, I didn't see you there. That was my blind spot and I was about to miss my turn. And so that's the viewpoint. Like, if you get into an accident, like something happens, you just want to bring your life back to the moment before it happened, whatever that might be. And especially when you don't grasp that they're underinsured, because you may not know that. So you're just saying, hey, well, I know you have insurance. I also know that my leg's broken and I'm out of work for 6 weeks and now I don't have paychecks and you have insurance. We should be okay. They may not realize that they are causing this massive ripple effect because 4 years ago when you bought your house or you got your car, you didn't take the time to dig deep and make sure you were covered adequately, or maybe your needs changed and you missed that memo. Like, that's why it's important. It's not to be doom and gloom in my eyes. It's to make sure that your friendships can survive moments like that. And you can still reminisce about it 6 years later and say, oh, I'm so glad that we're still friends. That's how I see it.
Yeah. And I actually, that popped up. I got a good nugget, an insurance nugget. On your homeowner's policy, you have personal liability and you have something called medical payments. Usually your medical payments are going to be, if done right, $5,000, $10,000, something like that. Sometimes as low as $1,000. But medical payments, I always explain it as the good neighbor coverage. So let's say someone was over at Adrian's house. He doesn't even have to be liable. If they trip and fall and they cut their hand, Adrian can pay their hospital bill through his medical payments. It's no money out of his pocket. It's not him taking liability. It's essentially a good neighbor's discount or good neighbor's coverage. So let's say those medical bills were $1,200. Adrian just files it with his homeowner's insurance. And I've talked to several adjusters. Typically, if you take care of someone on the front end, if you pay their medical bills and then you check in with them, you're going to keep them happy and you're going to keep it out of a lawsuit. So that's just a little tidbit, Adrian or Craig or anyone listening. You've got medical payments on your homeowner's policy. So if anyone were to get hurt, if your kid's friend were to get hurt, you can pay those medical bills for them. You're not taking liability. You're just saying, hey, this happened at my house. I want to help you out. So if in the worst case, someone listening that happens to you, that I think is always a good step.
Yeah, that's really cool. That's a really good piece of advice. I hadn't really thought about that, but yeah, you're exactly right. That's just a way to show that you have, good faith. You want to do the right thing, and that I think also, to Adrian's point, is going to help, preserve some friendships. And, that's ultimately the goal. And that's why you have the insurances, is to protect yourself and the people that you are involved in your life and that are close to you. So
Okay.
I think that's a great note to end on, actually.
Yeah. So how can people find you if they want to connect with you, Stanton?
Well, I'm a type that just gives out my cell phone number, which is probably why I have all the car warranty people calling me. I still haven't bought a car warranty. Side note, do you think anyone has ever bought one of those car warranties?
Oh, for sure.
Really?
I mean, let's put it this way: they make enough money to sustain a call center. So somebody somewhere has written a check for them.
Right.
God, that's a good point. Wow. Yeah. So, best way to contact me, my cell phone is 865-924-8475. You can call or text me. I mean, I'm a millennial, so I'm strapped to that thing. That's usually the best way to get a hold of me. And again, if you're a car warranty person, or what's the other one I get all the time? Visa, MasterCard. Yeah, if you're one of those, please don't call me. But anyone else, feel free. Call or text. That's usually the best way.
Well, hey, Stanton, thank you so much for spending some time with us today and sharing some of your expertise with us. We really appreciate you.